Hi, welcome to the Market Alert for Wednesday, 31st of July 2019. So all the news today is going to be about the Federal Reserve. We've arrived, it's D-Day. Will the Fed cut rates by a quarter or a half of 1%? But the news behind all of this isn't too rosy. As it says here, the Federal Reserve is gambling with the global economy. And here we've got former New York Fed head warns needlessly stimulating now will push stocks to unsustainable heights. They already are. And the implied is already indicating this as well. And another one here, if the Fed cuts rates now, it'll be an admission that a recession is imminent. Well, we know this from the inversion of the yield curve, and the reason it's not been in the Market Alert for the last few days is because they haven't been updating the site. And I always find this as a sheer coincidence that these things, when there's bad news or things are starting to turn bad, they stop updating for a while. And they did it many years ago with something else. It was business loans, and all of a sudden there was a plummet in the figures and they stopped updating it, and that was it. They won't stop updating this, they're just delaying it until they see what the interest rate reaction is to this evening's cut. But the main consensus, Morgan Stanley are saying at 0.5%, but 67% a quarter of 1%. But either way, it's not going to help. It's as simple as that. And also the market, if we look at the daily chart here, has already priced in a rate cut, because down in this area here, if you recall, Trump had a word with Powell in the boardroom, as it were, and said, look, you need to do something. The market's falling sharply here. We saw, if we go back to here, an increase in the implied volatility. Just drag this down a bit so you can see it. So we had the market falling. There was an 80% increase in the implied volatility. And with that, the market was comforted by that Powell would consider dropping interest rates. When all the way up to this point, it had been nothing but really good news. This is just pure manipulation and fudging to keep the market on the high. If the market's on the high, then the public are going to have confidence in the economy. That's all it is. It's smoke and mirrors. And yesterday, short squeeze sparks small cap spike, and crude jumps because of the problems in Iran, and cable dumps because they've got the knives out for Johnson in the UK as well. So coming back to the Dow, we're stuck in this sideways range. It goes without saying that we're likely to blast through. The question is, how long will it hold through this level? That's the key. And again, when you go back to the implied volatility, and you look down here, you can see that we've come through the 20 bar moving average, and there's some sort of weakness around there, marking up the options in anticipation of prices eventually coming back this way, because that's what happens when you get into the lows with the implied volatility. And also another thing to keep in mind is that they will start marking up the implied volatility as prices move higher as well, which is another way of spotting what is going on, which we'll do as the days unfold going forward. But yesterday, while we're here, we can see the overnight market is above the 200 bar moving average, which happened here just as the market closed. And during yesterday's session, you can see how the market also, you can see them buying at the start. Market higher, stops at the 200 bar moving average, then gets into 276% retracements, and then blasts through, but then comes back through. So the news today, of course, is, I'll just move this through, is all of this here. The Fed statement, this is out at 7 p.m. and they're looking at a quarter of 1% there, because 2.5 previous, 2.25. But we'll see if we get the shock and awe, just to keep the markets moving to the upside there. Meanwhile, in the pound, down again yesterday, we're finding a bit of support here. There's no major selling around in this market. It's just a case of let's put some pressure on. This is all coming from the Remain side, as it were, to make it look like we're heading for catastrophe. We already are. We're going to have to look at the inversion in the yield curve, but none of that is taken into consideration. The printing of trillions and trillions of debt during the last 10 years, end of the business cycle, global slowdown, the contraction in all sorts of economic data in China. But the only concern here in the UK is that the pound's lower. And as I showed you yesterday, in 1985, the pound to the dollar was at 103, and it's currently at 121. And as I've said before, I'm amazed this has not happened. But there's the reason it's getting marked down now, and to bring the Project Fear ratcheted up to a new level is purely and simply because there is the potential that Johnson could just push this through. He's not going to be stopping for the summer, that's for sure. Like the rest of them went into recess last week, and we'll see you in September. So much for getting things done. Incredible, absolutely incredible. Anyway, yesterday a bit of a sideways move. You can see the market moving higher, a bit choppy, as I would imagine this is going to be the same going forward for a bit, because it's going to be news driven on what Boris is actually doing at the moment. And then finally, in the implied volatility, they're stuck in a bit of a sideways range, but starting to move back towards the upside yesterday, which you can see in the 4 hour there, a couple of trades to the upside. And in the 15 minutes, I noticed that we still got a lot of these spikes, but it's starting to smooth a bit. Yesterday, there was 3 consecutive ones there, which meant that there was obviously a bit more activity. And then we had this one big spike that sent the market back to the 200 bar moving average. And you can see here, once we got through the 200 bar moving average in Bitcoin, things are starting to look a bit more streamlined and not as erratic as we saw over the last few days with these spikes. So with a bit of luck, we're getting back to a situation where the market is starting to create a lot more interest and momentum and smooth things out a bit once more. Again, you can see the market coming down and testing the 200 bar moving average and picking up the volume there at these levels. Okay, that will do it for this one. So hang on to your hats. D-Day has arrived. Is it going to be shock and awe or a damp squib? We'll find out at 7 p.m. this evening. So with that, as ever, thanks for watching. See you in the next one.